You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host, John McEwen. In this week's episode, we'll be discussing Shell, Airtel Africa, BT, Novo-Nordisk, AG Barr, and Meta. John, should we start with Shell, no longer
Yes.
Royal Dutch?
No, so they've changed that, and the ticker is now just Shell, pure Shell, and it's the FTSE 100's largest company and Europe's largest oil company. They had their fourth quarter results out this week, with revenue more than doubling to $90.2 billion, with the oil price offsetting a 7% decrease in production, leading to an underlying net profit of $6.4 billion, compared with only $393 million a year ago. In the integrated gas division, profits were up more than 3 times to $4.1 billion, excluding $2.6 billion relating to commodity derivative contracts. This was more than twice third quarter profits, with extremely strong performance in liquid natural gas, with increased efficiencies and price increases. Production volumes were down 1.6%. In the upstream division, underlying profits came in at $2.8 billion, compared with a loss of $748 million last year. And operating cash flow more than tripled to $7.1 billion. Production was actually up 4% compared with the third quarter, following the impact of Hurricane Ida. However, full year production was down 8% with the impact of asset sales and maintenance. The oil products division reported a profit of $555 million, up slightly on last year, but down 54% on the third quarter, with the increasing operating expenses and lower retail margins. Free cash flow increased from $882 million to over $10.7 billion, with the increase in profits and the proceeds from the sale of the US Permian business. Net debt fell from $75.4 billion to $52.6 billion. And capital expenditure for the full year is expected to come in at the lower end of guidance at around $23 to $27 billion. Shell also declared a quarterly dividend of 24 cents a share and is planning an additional dividend of 25 cents in the coming quarter, alongside an $8.5 billion share buyback in the first half. In terms of valuation, Shell has a market cap of just under £156 billion and trades at 8 times earnings, with a prospective dividend yield of over 4%. I thought these results were really impressive, as might be expected with the oil price at the highest it's been for over 5 years, and recently over the $90 a barrel mark, and also the surge in the gas price too. I think we've all been reminded also that in the UK, we're not yet in a position where we can rely on renewables. But I suppose there is the concern that the group is going to have to spend a huge amount in capital expenditure in the commitment to halve emissions by 2030. But I tend to think with the energy prices looking as they are, and that they're likely to remain high from some time, price to earnings of just 8 and the share buyback on the cards and the prospective dividend yield, as a Shell shareholder, I'm very happy holding them at the moment. Sam, what are your thoughts on Shell and these results?
So they're very good results. I agree a PE of 8 is very reasonable, but that's only if the oil price stays where it is. That's my concern with it.
Would you look to buy shares in Shell at the moment? Would you watch it, or would you just be completely out of it?
I'd just avoid it. It's kind of like when we looked at the miners a couple of weeks ago. You're just at the mercy of the commodity price, really. And when that does well, I know that the actual pure plays on it, the actual stocks, they can do a lot better. But yeah, that's the problem. Like 8 times earnings, if you don't know what the oil price is going to do, for me, I can't tell you whether or not it's good or not. Because I know we talked about it every time we've covered Shell on the show, but when we first covered it, it was literally at the very bottom, and I don't think we could have been more bearish, and we were completely wrong. And that's also that's been helped massively by changing the oil price.
Yeah, no, absolutely. So I suppose what you're saying is a cyclical business, and because you don't have any influence over I suppose it's very difficult to predict where you are in the cycle. It's a business you'd rather not own.
Yeah, it just goes in my too hard pile.
Yeah, fair enough. Well, we'll move on from Shell then, but in much better results than, well, over a year ago when we were talking about it last time. When
we literally called the bottom.
Yeah, I was. Yeah, I mean, I wasn't in a happy place then, but I did hold on to the shares.
For anyone who didn't actually listen, when we say called the bottom, what we mean is we couldn't have been more bearish on it, and that turned out to be pretty much the exact bottom.
Yeah, I think we were about £8 or £9 a share back then, and we're now over £20. So I think since this news, which was Thursday, the shares are up about 5%, but up well over 100% when you compare it with the lows that we were talking about the first time that we covered it.
That's the thing about a podcast. Our stupidity is immortalized on the internet forever. Yeah. It'll be a case study in 100 years in a business school or something, that episode, and just a graph of the share price since.
And sadly, it didn't go in the fancy portfolio.
It would not have gone in the fancy portfolio.
But it would have been the strongest performer. But anyway, Airtel Africa, another favourite of the show.
Airtel Africa. Well, for anyone who doesn't know, we've covered them a few times. They're a telecoms company based in Africa, but as well as the telecoms, which is more on like the mobile and the data side, they've also got Airtel Money, which best way to think of that is maybe like PayPal of Africa crossed with a bank. So they have come out with their Q3 results and reported revenue. And these are results for the 9-month period ended 31 December 2021. So for the 9 months, reported revenue grew 21% to $3.492 billion. Constant currency underlying revenue grew by 24.8%. Constant currency underlying revenue growth was recorded across all regions, with Nigeria up 29%, East Africa up 24.4%, Francophone Africa up 19%, and across all key services, with revenue in voice up 16.1%, and data and mobile money both up 37.2%. Underlying EBITDA was 1.703 billion, growing by 31.3% in reported currency, with an EBITDA margin of 48.8%, an increase of 326 basis points, led by both revenue growth and improved operational efficiencies. Operating profit grew by 43.1% to 1.146 billion in reported currencies. Profit after tax almost doubled to 514 million, as higher profit before tax more than offset associated tax charges. Basic earnings per share was 11.7 cents, an increase of 113.8%, largely as a result of higher profit. Earnings per share before exceptional items increased to 11.5 cents, up from 5 cents in the previous period. Operating free cash flow grew by 42.2% to 1.271 billion, and net cash generated from operating activities was up 23.1% to 1.499 billion. The leverage ratio improved to 1.4x from 2.1x in the previous period. The customer base expanded to 125.8 million, growing by 5.8%, with increased penetration across mobile data, the customer base up 11.1%, and mobile money services with the customer base up 19.6%. Customer base growth was affected by the SIM regulations in Nigeria, but returned to growth in this region in the third quarter. Excluding Nigeria, the customer base grew by 12%. In terms of the key financial information for the quarter, rather than the 9 months as a whole, voice revenue was up 9.9% in constant currency to 606 million. Data revenue was up 37.7% to 395 million, and mobile money revenue was up 29.2% to 148 million, and other revenue was up 18.2% to 105 million. The net debt has decreased from 3.518 billion to 3.05 billion. The return on capital employed has increased from 15.5% to 21.5%, and it's a bit irrelevant because they're not in the same industry, but it does have a higher return on capital employed than Diageo, which I always find quite interesting. Average revenue per user was up 14.8% to $3.3. Total customer base up 5.8%. So in terms of the valuation, so it's currently showing on Hargreaves Lansdown a PE of 23.57. However, that's based on last year's full year results. So if you add in the increase in profit for the 9 months in the year to date, so you go on trailing 12 months, it's actually at a PE of 13.71. And that's despite the very good share performance. In the last 6 months, the stock's up 69.86%. And in the last year, it's up 90.18%. And it's still only at a PE, because the business has done so well, it's just really moving up in line with the business. It's still only at a PE of 13.71. I own it. It's my biggest holding. I know you own it as well. I think it's still a very cheap stock. John, what are your thoughts on these results and the valuation?
I mean, it doesn't seem very expensive. I mean, I think it goes without saying that the results were really impressive, and also the metric that you highlighted, the return on capital employed being above 20% and higher than Diageo. I suppose the things that maybe bring the valuation down a little bit are the regions that it operates in, and the potential for some of those sort of countries that are less stable maybe to not accept things, or in fact, what am I going to say?
Nationalize. Is that the word you're looking for?
So I suppose, one of the things is that the countries that it operates in are inherently less stable. And you could have things like nationalizations and I suppose inherent currency risks in some of those regions too. So it's not like you're comparing this with a company that's operating solely in the US or the UK, for example.
Yeah, but where else are you going to find a company at 13 times earnings that grows at 20% a year?
Well, yeah.
So you are being well rewarded for that risk.
Yeah, and that's why I bought shares in it.
Yeah, it's FTSE 100 now.
It is. So I think did it join last week?
Yeah, the 31st. I think it joined 31st of Jan.
Yeah. So so whether it gets more coverage now as well, because I think when it was FTSE 250, it definitely got some, but joining the top 100, you'd expect to be covered a bit more. So hopefully, we'll see what happens, but I think it'll be better known, more of a household name soon.
And it's in the fancy portfolio now as well.
It is double allocation.
Is it a double? Oh, well, that's just.
I think I'm pretty sure we said double.
It's up 10% already in the last month, so that's going well. Yeah. In fact, we put it in 2 months ago, didn't we? But I know it was 1 month. But as well, I think as well, with it being in the FTSE 100. I mean, if you look at it compared to when we started covering it about a year ago, like say the business is up 90%, but the business has done very, very well. It's moved very much in line with the increase in earnings. In terms of the ratio, from memory, I think it was at a P of about 11, and it's just under 14 now. So there has been a slight revaluation, but it's still very, very cheap. And it wouldn't surprise me if we do start to see it getting revalued to a P of 20 or 30, because it just seems far too low, really, for the numbers it's putting up. And numbers that it's been putting up for a few years now. It is constantly delivering.
And I suppose the debt's coming down, and there is talk about whether the payment side of the business will be spun off.
Yeah. So there's a lot to be excited about, I think, as long as they don't nationalise any parts of the business.
Or all of it.
Yeah, or all of it. Right, should we move on to a business that was formerly nationalised?
Yes, so BT Group, so the owner of BT and Openreach, had their third quarter results out this week, with underlying revenue falling 3% to £15.7 billion in the first 9 months of the year, with delayed COVID recovery and supply chain issues. The global and enterprise revenues fell particularly steeply. However, cost control meant that underlying profits, EBITDA, actually rose 2% to £5.7 billion. And BT is expecting full year revenue to fall 2%, with the remainder of the other guidance remaining the same. In a little bit more detail then, the consumer business saw revenue fall 1% to £2.6 billion, whilst cash profits EBITDA rose 17% to £628 million. There was slightly higher demand for BT Sport and broadband. However, there was a shift away from buying handsets to SIM-only deals. In the enterprise division, revenue was down 6% to £1.3 billion, with declines in older products and contracts, leading EBITDA down 8% to £400 million. In the global division, there was reduced customer business activity, and EBITDA fell 25% to £114 million. In Openreach, revenue grew 4% to £1.4 billion, with EBITDA up 6% to £807 million, with higher rental bases of fibre products and Ethernet. BT also announced that it's reached an agreement in principle with Sky for a new longer-term reciprocal channel supply deal beyond 2030. It also entered into an exclusive discussions with Discovery to create a joint venture with BT Sport and Eurosport UK. In terms of valuation, BT has a market capitalisation of £19.1 billion and trades at just 9.8 times earnings and yields approximately 4% after having its dividend suspended. I thought these results were disappointing, with the exception of the Openreach part of the business, and probably wouldn't be looking further into BT. We've discussed it before, but BT has a huge pension deficit, and the new payment plan is costing hundreds of millions of pounds, and it's set to go on for every year for most of the next decade. And moreover, the group's debt costs more than £770 million in interest payments alone. And combine that with the huge capital expenditure that's required in the industry and doesn't seem to leave much room for profits. I wouldn't be investing. Sam, do you have any thoughts on BT and these numbers?
Yeah, there's nothing particularly inspiring in there. I also do not like the business at all. The debt's a massive red flag. Pension deficit's always a massive red flag. And I just find it very, very lackluster. Just every bit of it, really. I thought it was interesting that he said that there's a shift from buying handsets to SIM-only deals. Because that's going to be, the phones are so good now that when you get to the end of the contract, you don't need to get a new one anymore. Because I was one of them where every 2 years I was getting the new phone, and then like a year ago when mine ran out, the phone is still good enough and the battery's still going fine. So I've not bought a phone for like 3 years. It's strange that doesn't seem to pull through into the Apple numbers at all. But
yeah, I think that's right. That's right. It's yeah.
I saw that they're looking. Yeah, what they said that they were holding talks to explore ways to generate investment in the BT Sport division. So apparently they might be thinking of selling that off, which would probably be a good thing. So I don't think it really does much either. The problem is they're just going to sell it. It's just going to be used to pay down the debt. So maybe for a shareholder, you'll earn more of a slightly smaller business. But it's certainly won't be going on the watch list for me.
No, fine. Any upsides that you see to the business?
To me, it's always looked so unattractive that I've never had a proper dig into it. But there's a couple of pretty good analysts that have had a look and seem to like it as a bit of a value play. I think I was listening to Phil Oakley's podcast. This is going back a few months now. And he thought there was some value there and he quite liked it. Whereas for me, there might be value in there, but I don't know, catching a falling knife's not really my style.
Fine. So let's move on to what's your next company, Sam?
Novo-Nordisk. Yeah, so it's we're cheating a little bit. It's not actually UK listed. It is listed on the Danish market. And we have actually covered them before, but they are the world's largest supplier of insulin, and they produce about 50% of the world's insulin. They have come out with their full year results, and 2021 revenue adjusted for currency movements rose 14% to 140.8 billion. And all these figures are in Danish kroner. So let's find out what the exchange rate is. So 1 Danish kroner is worth about 11 pence. So revenue adjusted for currency movements up 14% to 114.8 billion Danish kroner, which reflects upticks in both international operations and North American operations. Operating profit excluding currency changes rose 13% to 58.6 billion. In 2022, the group said they expect to see 6 to 10% sales growth and 4 to 10% operating profit growth adjusted for currency movements. It's worth noting this business has an operating profit margin of over 40%, so it is a cash machine. Well, that's not really surprising for anyone who's seen the prices that they charge. Sales growth was evenly split across international operations and North American operations, with each division up 14%. In North America, insulin sales declined 9% as volumes and prices decreased. This was offset by growth across all other product categories. Sales rose across all therapy areas within international operations. Sales in diabetes and obesity care rose 15% to 121.6 billion, driven by growth across all therapy areas and geographies. Obesity care sales were the strongest performer, up 55%, followed by diabetes care, where sales rose 13% and market share improved from 29.3% to 30.1%. GLP-1 treatments were the main driver, offsetting weaker insulin sales growth. Operating profits rose from 43.7 billion to 49.5 billion. Biopharm operating profits declined from 10.4 billion to 9.1 billion, reflecting price declines in the US. Sales rose 4% to 19.2 billion, driven by 6% sales growth in rare blood disorders revenue to 10.2 billion, as the group launched 4 new products in this category. This offset a 2% decline in rare endocrine disorders, reflecting a 12% decline in North American sales. Sales and distribution costs rose 15%, reflecting promotional activities in North America and new product launches. R&D costs were 16% higher as the group made progress on its pipeline with cardiovascular disease and NASH. Free cash flow rose to 29.3 billion from 28.6 billion last year. Though including acquisition costs related to the acquisition of Dicerna Pharmaceuticals, that figure was lower at 11 billion. Free cash flow is expected to rise to between 50 and 55 billion as the Dicerna acquisition is absorbed. The group had net debt of 9.2 billion, up from a net cash position of 2.4 billion, reflecting an increase in debt obligations. In terms of the valuation, it's trading at a PE ratio of 29.4, and that compares to a 10-year average of 21.5. And the prospective dividend yield over the next 12 months is 1.7%. It's worth highlighting as well, although it is very, very profitable with operating margins over 40%, the insulin pricing is under pressure in the US with more competition in the smaller haemophilia business as well. I thought these results looked fine, but I think it looks quite expensive for the numbers it's putting up. What do you think, John?
Yeah, I would probably tend to agree with you that it is on the more expensive side, but it is very high quality. And if you saw obesity as a growth trend and more of the world becoming developed and becoming obese, you can see with margins like that and potentially the revenue going up too, increase in sales. So I can see why it's valued as it is, but I don't know probably enough about the competition in the market and how long price pressure, patents and price pressures on some of their products. I think that would be probably a concern. But again, it does look good.
For anyone who doesn't have an obesity play in their portfolio already, it's one to take a look at.
Well, that's essentially what their products are. Well, a lot of them, are hinge around. So yeah. But would you look at this in any more detail? Is it one that you'd consider?
It's probably, it's like the pharmaceutical ones. I can see the appeal, but for me, it probably just goes in the too hard pile. I think it's quite expensive anyway, actually, but it does look like a good business.
And certainly putting up much better numbers than Glaxo to sort of, I suppose, justify those higher prices or that higher rating. Yeah,
it's just for me, it's very far outside my circle of competence.
Fair enough. Okay, so back to the British companies then. We've got AG Barr, which for anybody who doesn't know is a UK drinks maker and soft drinks maker, I should say, whose brands include Iron Brew, Rubicon. Well, actually, it's not entirely soft drinks now because they've got Funkin' Cocktails, which has been one of their stronger performers. And they released a trading update this week ahead of their full year results due on the 29th of March. The group confirmed that it expects full year revenue to be up to £268 million, which would be 17.5% ahead of last year and actually ahead of pre-pandemic levels, which were £255.7 million, and also ahead of their previous guidance that they'd issued in November, which was for £264 million. Operating margin before exceptional items is expected to be around 15.6% compared with 14.8% a year earlier, with pre-tax profits on the same basis marginally ahead of guidance of around £41 million. Roger White, the group's chief executive, said We've delivered on our excellent financial performance against a volatile backdrop, and the group added, we have initiated several cost control actions to reduce the impacts of these rising costs and have adjusted our pricing with customers where appropriate. With the published rate of inflation in the UK now above 5%, the highest level for 20 years, we will continue to seek opportunities across the coming year to offset the impact on our business. In terms of valuation, AG Barr has a market capitalisation of just under £585 million and trades at just under 17 times earnings, compared with a 10-year average of closer to 20. So it has a prospective dividend yield of around 3%. I mean, we covered Britvic last week, and I think what we were saying was it had a much stronger brand portfolio. A much stronger brand in its portfolio. I don't think that means AG Barr is at all a bad investment, and it does have strong brands itself. Numbers from Funkin Cocktails have been particularly good, and it's been on back of the growth trend with having drinks at home, but also it's become quite a trendy brand in itself. So the on-trade sales haven't been bad for it either. And it's important to point out that AG Barr has a net cash position of £66 million. It's very healthy financially, although I think if you were to be a bit more bearish about it, it is still sort of looking at probably single-digit growth in the revenue growth in the next couple of years. But it is cheaper than Britvic, partly for that reason, and probably the quality of its brands. Probably not one, I think, again, a bit lackluster, that I wouldn't be buying shares in, but I don't think it's a bad company. What are your thoughts on it, Sam?
Similar to you, it's probably worth highlighting. I think when we looked at Britvic last week, we tried to get the PE, and the one we got, I think, was about 20 or something compared to 19 for Britvic. So it looks like that was wrong. It must have been an old figure, or just based on the last set of results rather than the year to date. But yeah, 16.8 is cheaper than Britvic, but yeah, if you look at the brands, it probably should be cheaper than Britvic. I think one of the other things I like about Britvic is it's actually got some international exposure with the Brazil side and the other international, whereas I don't think AG Barr really has that. I think it is much more of a UK play, and a UK play really with, I think, much weaker brands than Britvic has. I think the dividend yield's quite good actually at 3%. And I know that with John Kingham, who we've had on the show, he's got AG Barr shares, but for me, I'd rather pay up for Britvic.
Yeah, no, I'd be in agreement with you on that for sure. Unless they start selling Iron Brew, or Brazil develops a taste for Iron Brew.
Yeah, I don't know. Stranger things have happened. I don't know how anyone could develop a taste for Iron Brew, but Scotland has. So.
Okay, fine. Okay, so on to our American company of the week, Sam.
Yes. So our American company of the week is Meta. You will probably know it by the name Facebook, though, instead. So they have come out with their Q4 results, and fourth quarter revenue rose 20% to $33.7 billion, as ad impressions and price per ad increased by 13% and 6% respectively. But a 38% increase in costs driven by rising R&D and marketing and sales spend meant operating income was down 1% to $12.6 billion. The group expects first quarter revenue to grow between 3 and 11%. Increased competition, together with a shift towards engagement with video content, which feeds fewer ads, are expected to negatively impact ad impressions, while regulatory changes, Apple's iOS changes, and the impact of inflation on advertising budgets is expected to weigh on pricing. The shares fell 21.5% in after-hours trading, and I think on the day after the announcement, I think they were down by about a quarter, which was, I think, one of the biggest ever drops in market cap ever. I think they lost about 250 billion of market cap in a day or something. It's crazy. So yeah, so if we go in a bit more detail, average of 2.82 billion people use the group's platforms, including Facebook, Instagram, and WhatsApp in December, an 8% increase. Monthly active users were up 9% to 3.6 billion as of 31 December. The group is breaking out its augmented and virtual reality hardware and software under the division Reality Labs from the fourth quarter onwards. Income from Facebook, Instagram, Messenger, WhatsApp, and other services will be classed as family of apps. So family of app revenue was up 19.9% to 32.7 billion. But rising costs meant operating income rose 6.8% to 15.9 billion. Reality Labs brought in 877 million, up from 717 million, but posted an operating loss of 3.3 billion. As of 31 December, Meta has just under 72,000 employees, which is a 23% increase. Meta had a net cash position of 48 billion at the end of the year, and free cash flow rose from 9.2 billion to 12.6 billion, reflecting increased profits and lower spending. The forecast for capital expenditure in 2022 is unchanged at 29 to 34 billion, driven mostly by investments in data centers, servers, and other infrastructure. In terms of the valuation, it's now trading at a P/E ratio of 17, and that compares to an average P/E since listing of 31.3, and it doesn't currently pay a dividend. However, it is buying back shares. My view is I'm not particularly worried about these results. I just think it is such a strong business. I think it's a business everyone likes to hate, but people do still need it. I think lots of small businesses are absolutely dependent on it. I think when you look at what Google have been able to do over the last 10 or 15 years, I think you'll see the same thing with Facebook, where they're going to be able to keep increasing the prices because I think the offering is that valuable. I think for the big blue app, so the main Facebook app, I think I wouldn't expect much more growth. Maybe it's just going to rise in line with the population, but it's still got Instagram, which is still growing a lot. I just think, I think it's just so ingrained as a business into society and advertising that I think at 17 times earnings, I don't think there's a huge amount of risk here. And I think that's just with the main business, which I think will go for years and years in the same way that Google has over the last 15 years. In terms of the virtual reality and doing the Oculus and all that money they're investing, I don't particularly have an issue with it because I think the shares are priced such that if that doesn't work, that's fine. But if it does work, then obviously it would be very good if the next sort of generation of hardware was owned by Facebook, because then they're not at the mercy of Apple's iOS changes or anything like that. But so whether or not that will happen, or if they're just going to burn a load of money for something that maybe doesn't catch on or whatever, I think that's fine, because I think it's so cheap that you don't need Oculus to work really to make good money on Facebook at 17 times earnings. What are your thoughts, John?
No, I would tend to agree with you. I think it's a very high quality company. I was just going to, because you own Facebook shares now, don't you, Sam?
I do. So on the day it dropped a quarter, that was the day I opened a position, because I just thought at 17 times earnings, I just think that risk reward is just massively skewed, really.
Do you have any concerns specifically about the results? Do you think it was the market sort of overreacting, that it missed expectations, and that's why you've just had such a sharp fall? Or do you think there is any sort of validity in the underlying concerns with it?
Well, I think the main thing was the daily users? I think they dropped by 500,000 since the last quarter or something like that. And that was the first time I think they'd posted a decline. To me, it struck up a lot of similarities to Apple in 2016, where I think they'd had declining iPhone sales for the first time, and everyone was acting as if this was the end of the world for Apple. And if you look at how the business has performed since then, it was actually a really good time to buy. I think you can't expect it to go up in a straight line forever. You're going to get these little blips, but I think people do need to be on there. And what I like as well is even if the big Facebook was to start declining, which I don't think it will, just because I think there's too many, the network effect's too strong. I think I hate Facebook, but I'm still on it because you've got to be. Everyone is. But even if that was the case and it's not getting that younger generation, they're all on Instagram anyway, so it's not really a problem. I'd probably be more concerned if it didn't own Instagram.
Okay,
is it good enough for the watch list?
Oh yeah, no, absolutely. It would be good enough for the watch list. I mean, I think I probably have a fair bit of exposure to Facebook anyway. I think it must be between 1% and 2% of my portfolio overall, just on the basis that it makes up such a large part of the world index. So whether I buy Facebook as sort of, I suppose, a pure player or on its own, possibly. I think it's certainly going on the watch list. So
of the 6 businesses we've discussed this week, so Shell, Airtel Africa, BT, Novo-Nordisk, AG Barr, and Meta, if you had to buy one, which one would it be?
Probably Airtel Africa. And yeah, for the reasons that we talked about earlier, I'm excited about the growth, and I think it is probably undervalued too. So I'm keen to watch it closely over the next few years.
I would agree as well. I know it's boring, but Sorry.
But you have bought Meta this week, so
I have, but just because Airtel Africa's 20% of my portfolio now, I can't really be adding to it anymore.
Okay.
But if I didn't own either, I'd be buying Airtel Africa before Meta. But I do obviously like them both because they're both in my portfolio. So before we go, we do have a very quick book review. It's Irrational Exuberance by Robert Shiller, who's the guy who created the CAPE ratio. I'll just read the blurb actually because it sums it up quite well. So this is the 3rd edition, and it's in this revised, updated, and expanded edition. New York Times bestseller, Nobel Prize-winning economist Robert Shiller, who warned of both the tech and housing bubbles. Interestingly, though, he did write this edition was in 2014, and he talks about the bubble that's going on there, and that one's still not. Well, the market's done quite well since 2014. Considers the behavior of investors and markets in the wake of the 2008-2009 financial crash, tracking stock and bond prices as well as the cost of housing in the post-subprime boom. Schiller shows how recent asset markets capture and inherently reflect psychologically driven volatility. In other words, irrational exuberance is as relevant as ever. Yeah, so it's almost like a study of bubbles. So it looks at previous times the stock market's been at cyclically adjusted high PE ratios. So I think it's 1920, 1960, and then 2000. And it looks at all the things that could have caused it, and it'll sort of investigate them in a fair bit of detail. So it'll ask people it'll look at surveys where they've asked people what their thoughts are on the markets immediately before crashes and stuff like that, or like psychological impact. Or it'll look at things so when was it? I can't remember what it was in response to, but there was an investigation into a flash crash or something in the US, and the conclusion they came to was they blamed a tax change or something that was being talked about in the US. But then he said if you actually go through the US headlines in the newspapers and search for it, and the 5 days before this crash, or was it maybe it was 1987, maybe it was the Black Monday in 1987. But anyway, there was an investigation set up to look into what caused it, and a tax ruling was quoted as one of the things. But if you go back and look at the headlines in all the major newspapers in say the month up to the crash, it barely gets any coverage. So it's probably not the case. But yeah, it is interesting. It does cover a lot of stuff. It comes in at quite a high level, but for me it was a bit too academic. It was very much this is what we'll look at, and this is what the data says, and it was interesting, but it definitely wasn't the most entertaining read.
Okay, do you think you could apply it to where we are now? Would you take anything from it in that sense?
I think it's difficult because it's always obvious in hindsight. So when he's talking about these previous ones, it's very, very obvious. But this edition, I don't know if it's been updated since, but I read the 3rd edition, and that was written in 2014. And he talks about how high it is then. And he does caveat by saying the problem is you just don't know how long these things could go on for. Because I think if you look at Japan before they had their big crash 30 years ago, the CAPE ratio was at 100 or something, and the US has never. I think even now it's only at 40 or something. So that to get to where Japan was, it'd have to increase 2.5x without any increase in the underlying earnings, and it's really difficult to say where they'll end up. And then as well, we operate in a much lower interest rate environment, and he does cover that as well. And he says that historically, if you've looked at periods where interest rates have remained very low, it's been less of a problem to pay high prices for stock. So it's really difficult to say, but I'm sure it'll be very obvious in hindsight.
Yeah. So out of interest, Sam, what do you think of valuations in the markets, whether it's in the US, in the UK at the moment?
It's difficult because we've had a lot. I mean, in the UK, I think it's just steady as she goes, really. I think the UK is just still a very cheap market, and it has been probably in the whole period we've done the show. I think in the US, I think it's interesting because the indices are quite close to the all-time highs still, but then if you actually go in and look on an individual basis, what you've got is big tech propping up the crap performance from everything else. So you've got a lot of stocks in the NASDAQ and even the New York Stock Exchange where they're down 40-50% from the highs, and that includes a lot of the growth stocks from what were the COVID companies. So I don't know, even in my own portfolio, Etsy's down over 50%. And a lot of my growth stocks are down over 50% from the highs. I think Upwork's down just over 50%. Peloton's down a lot more than 50%. But we've covered that before. What else do I have? Can't remember. Mercado Libre, that's down just over 50%. And I don't know, some of them, I think the valuations are starting to look fairly reasonable. I mean, Fiverr, which I opened a position in a couple of months ago now, but that's pulled back from a high of over $300 a share, maybe $340, $360, and that's $80 now. So yeah, so I don't know. I think overall they're still quite expensive, but it's really difficult because you just don't know how far they're going to fall, especially when they're unprofitable companies. What about you?
I mean, I think in the UK, it's definitely doesn't seem expensive or toppy with a lot of the companies. I think when it comes to the US, it is very difficult to say, and the types of companies we're talking about now are very different to the types of companies that we've had in the past. Like you say, with some of the big tech, it's not something I'm overly concerned about because my strategy broadly is just sort of indexing, so buying small shares in or small part of the world index every month and just sort of sitting back and forgetting about it. So whether it's high or it's low, I'm not too worried, and just doing that and seeing the power of equities in the long term or over the long term. But I think it is very difficult to tell. Certainly some companies do seem expensive in the US.
It's difficult as well because I mean, even with companies like, I mean, we covered Microsoft last week, and how like the problem I had with it was I don't know how you value it because I don't know how big it could get. But it's really interesting because if you go back 120 years and you were to look at two of the big boys of the day, US Steel and Standard Oil, they could not put up the kind of numbers Microsoft can because it's so capital intensive. We've never seen businesses of this size that are able to grow so much. So there's not really a limit on how big they can get. And so it just gets to a point where just such a high proportion of GDP is going into these businesses that it can't really go any higher. But it's as to where that figure is, no one knows because this has never happened before because it just takes too long to, if you're in a capital intensive business, you're just never going to grow it to that size in that shorter period of time. So it is interesting. It's exciting to see.
And I suppose where the regulation comes in to disrupt things, that I suppose that's something else.
Yeah, well, especially with a lot of the big ones. If you look at them, they've got quite a few different things inside them that could feasibly be split off if they get too big. But I don't know, in this globalized, because it's all US as well, in this like globalized world, would you want to do that? And is it like if you look at like what Standard Oil were doing, there were actual monopolistic practices going on there, and the customer was being disadvantaged because what they do is they drive everyone else out of business and then up the prices in areas once they were on their own. And can you say that customers been disadvantaged by Amazon Web Services propping up what is like a very low profitability e-commerce business?
Yeah.
I don't like, honestly, I don't think the customer has been disadvantaged as long as they don't mind selling all their data.
No, I would tend to agree with you as well. But no, just a point for discussion at the end of the podcast.
Right. So in that case, I think that's everything. So thank you very much for listening, and we'll see you next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIW_tweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.